Hello and welcome to today's webinar. We will be discussing convertible notes. My name is Jerisa and I'll be your moderator for today. I'm here from the early growth team. So I just have a few quick notes before we start it. For anyone who is on the call or registered, this webinar will last about an hour and include some time for Q&A. There will also be a recording of this webinar available to you within 48 hours after the webinar. And that is it. So let's get started. Again, I am here from Early Growth. Here's a really great quote from the founder and CEO, David Ehrenberg. If you're not familiar with Early Growth, we do on-demand CFO services, including finance and accounting, tax preparation, and much more. So please find us on LinkedIn or at earlygrowthfinancialservices.com to connect with us. And today we have two of our great CFOs here, Alaa and Sirk, and I'm going to let them introduce themselves to you.
Yes, hello everyone. My name is Alaa Ismail. I'm one of the consulting CFOs here at Early Growth. I've been with Early Growth for coming on 10 years now. I specialize primarily in SaaS companies, but I've done everything from e-commerce to manufacturing and service companies as well. I've had the opportunity to work with companies in all stages of their growth, from seed round, angel invested rounds, all the way up to pre-IPO. It's been a really, really nice experience working with all these companies at the various stages. That's a little bit about me. Sirk?
Thanks, Alaa, and thanks, Teresa. Hi, everyone. My name is Sirk Rowe. Thank you very much for taking time out of your busy schedules to spend an hour with us. I am a consulting CFO with Early Growth Financial Services as well. I've been with the firm for 6.5 years. So while I consider myself one of the old timers at the firm, I'm nowhere near as of an old timer as Alaa, who's been around basically since the very, very beginning. And like Alaa, I've been working with early stage companies and later stage companies, in different phases of companies and in different industries, SaaS companies, e-commerce companies, web portal companies. I even do some work with consumer products, hardware, software, basically you name it. I've probably done a little bit of it. Prior to Early Growth, I worked as CFO and VP of Finance and Director of Finance for several early stage tech companies here in the Bay Area. So that's a little bit about myself, and maybe we can go ahead and get started.
That's right. So I'll start things off here, and essentially just kind of, for those who are not familiar with convertible notes, just a basic description of what they are. Convertible notes are debt instruments. They typically they are for a short period of time, meaning anywhere between 1 to 3 years. And these debt instruments convert to stock upon certain events that are contractually mandated in the conversion note agreement. They are debt. So they have provisions for repayment, but in most cases, or actually in the majority of the cases, they will convert at some future event. They are widely used, whether they're called safe notes or convertible notes. They are basically used in all stages or preliminary stages of the company, especially in the angel investing rounds, because they have certain attributes that are very useful early on. So when a company is first starting, one of the biggest issues that they have is that they really don't have a valuation. And in a scenario where you have an angel investor, a single investor, it's very, very difficult for a company to say, here's what our valuation is at this stage very early on. and the company is not interested in diluting themselves, meaning like underpricing their valuation at the early stage, and the investor is not interested in overpaying. So a convertible note really helps in both respects. It helps the company not worry about the valuation and gets them the funds they need to get started. But it also helps the investor by assuring them that at some future date, that investment will be fairly valued based on typically a follow-on financing round or in the near future that has a better chance of figuring out what the valuation is. So the primary feature of a convertible note is that there is no dilution immediately when the note is agreed upon. There are no tax impacts because it is debt, and there are initially no shares, so there are no taxes for the investor. There's no related taxes for the company, and it's something that can be done fairly quickly because there are no pricing disputes. There's no valuation back and forth, and it could get the company the funds they need very, very quickly and get the investor the assurance that they need also very quickly. So those are, kind of the primary attributes of what a convertible note are. Next slide, please.
Fantastic. Thanks, Alaa. And actually, and this is Sirk, and before we actually talk about this slide, just one quick note, I don't think it was mentioned at the outset, which is that to the extent that you have questions, feel free to just type them in using the chat function. We will be monitoring that, and we'll try to save some time at the end of the presentation to answer questions. But to the extent that there are some questions that pop in and we're on topic, then we'll try to get to those as well. So feel free to just go ahead and chime in. Okay, so Alaa mentioned on the previous slide that convertible notes are kind of used relatively early in funding stages. This is just a quick slide to just kind of highlight or just summarize the different funding stages, life cycle of a startup. You basically start at the beginning when you're first starting to get going. You're probably working on product development. You don't have revenue yet. And during those really early stages is when convertible debt is most often used. As you get a little bit later, as you start having revenue, as you start growing the company, you'll get into later and later stages of financing, equity financing, as you can see in this middle chart here. But that's not to say that you can't use convertible debt during those stages as well. And then obviously later on, whether you sell the company to a bigger competitor or somebody who's trying to get into the market, or you do an initial public offering and you're in the public market, then obviously we're talking about a completely different animal. But to Alaa's point, convertible debt is the timing of when you would use them is more often in the early stages, really early stages, and say during this first quadrant or the first column here during the angels, seed capital, and maybe prior to a first round of equity financing or a Series A. And the reason that's used more often at these stages is this is kind of when it's a little bit hard to come up with a valuation. And investors want to invest in your company. You want to bring in capital into your company to allow you to grow and to hit certain milestones prior to going out and getting equity financing. But it's just it's too expensive. It takes too long. The valuation negotiations with potential investors get to be get out of hand, and for all those reasons, doing a convertible debt round of financing prior to an equity financing makes a lot of sense for a lot of companies. But that's not to say I've seen companies prior to a second round of financing, for example, they're going after a Series B round of financing, and for one reason or another, maybe it's taking a little bit longer. to close around the financing, and they're worried about kind of running out of money. And so they might, go out and do a small convertible debt round of financing with their current investors, right? As more of like a bridge financing, before they close that second round of financing. So it can be used in later stages. We'll talk about it more from the standpoint of kind of an early stage investment. Okay, and then to just go a little bit deeper into kind of what it really is. Here we say looks like a fish and flies like a bird, and what it is that it is a debt, as Alaa mentioned. But for all intents and purposes, we can treat it not from an accounting perspective, but from a cash perspective and an investment perspective. We can almost treat it as equity. It just hasn't been priced yet, and therefore it can't show up on our balance sheet as equity. It shows up on our balance sheet as debt. We do, as you can see, that it's technically a debt, so there is an interest rate that is associated with it that we will ultimately have to accrue, but it's not an interest that we will be paying out in cash, and we'll talk a little bit about that in the future. Rather, the interest that is earned by the investor will also convert into equity during the equity round of financing. And as I mentioned, it behaves really more like a stock from the standpoint of that it's really not meant to be paid back. So even though it's debt, unlike a bank loan, which is debt, unlike other loans that you may take out, which you're expected to pay back, including the interest, convertible debt is really meant to be converted into equity. And so while it is technically debt, we don't expect to pay it back. Investors who are investing in convertible debt shouldn't be expecting it to be paid back in cash. Rather, they should be expecting it to turn into equity at this future conversion event.
Okay, so what are the features that you typically see in a convertible debt agreement? The one overriding feature is that it's a short-term agreement, meaning that it's not really meant to be a long-term debt financing or a long-term financing instrument. Because as Sirk mentioned, the primary goal for this is to get us to the next financing round. So you typically have these agreements, typically 1 year. I think the most that I've seen is 3 years, but they're typically short-term in that respect. The other primary feature is that they're simple. They're an agreement that can be drafted by an attorney fairly quickly. They could be easily understood by both the investor and the company very, very quickly, and they are implemented quickly so the company gets the funds they need to get the process going. Another main feature is that typically these agreements are flexible. They're not going to tie down the company or the investor in a very rigid way, because remember the primary purpose of this agreement is to get to an equity round. So they want the terms of the agreement are flexible, so they don't scare any potential future investors off, and give both the company and the note holder some leeway on maneuvering in a future financing event. There are, as we mentioned a couple of times, there's no valuation. So when somebody gives you $1 million convertible note, you don't have to figure out what that $1 million is worth from a company valuation point of view. It's just a dollar and cents transaction, so that you don't have to go through any kind of formal valuation. And because we mentioned before they're simple, the terms of the agreement are largely standard. So, if you go from one company to another, typically the terms of their convertible note are not that much different from another company. So these are the primary features of convertible notes. Next slide, please. So what are the advantages? As we mentioned, it's a short-term short agreement. It's not anything that is complicated to negotiate. So they close quickly. You get the funds quick, and you start using the funds to grow your company fairly quickly. They're simple. In early stage, you don't have to spend a fortune on legal fees just to negotiate the deal. They're flexible. So if, even though it's a year agreement and you find out 3 months into the agreement that you have a financing all lined up and you could raise a round, you could close that agreement at any time and convert it to equity. As we mentioned, this is really big. There's no valuation, so there's no back and forth from the note holder. It's purely a dollar transactions initially, and the other advantage is that they're standard terms, so they're easily understood by both parties, and you don't have to really negotiate.
Hey, Alaa, let me just interrupt for just a second because we actually have a question from John that pertains to this. His question is, if you raise from several seed investors, is it better to do them all at the same time with the same terms or sequential? And there really is no right answer to that. As you can see from what Alaa just mentioned, that one of the benefits is flexibility. And so, excuse me. And so usually what will happen is you will kind of put together a convertible term sheet that will be distributed to potential investors. Whether you close them all at the same time or whether you kind of do them sequentially is kind of up to you. I think you'll find that it's easier to kind of group a set of investors together because they kind of all want to know that there's other investors coming in at the same time, and it's just not just them. And so usually what will happen is there'll be a set, maybe 2, 3, 5 investors who are interested in doing it, and you'll kind of float the terms of the convertible term sheet. People will agree, and those initial investors will sign on. But then the beauty of something like this is that 3 months later, let's say you find a new investor that wants to participate. There's nothing that keeps you from just floating the same terms to that investor as well, and just taking on new money. Obviously, they'll have earned less interest because they've never earned interest during that initial time period. But the flexibility allows you to do it whichever way makes sense for both you as the founder as well as the investors.
Yeah, that's a great point, Sirk. And actually, in the majority of the cases, in a lot of the companies, it's not just one note holder, meaning that the convertible note is not just one funder. It could be, and it's actually the majority of the cases, it's typically several investors that are coming in, but under the same general note agreement or convertible note agreement. So the terms don't vary very much between the different parties. They're almost always the exact same. However, having multiple investors with multiple closes is very common. Okay, so how do these notes typically work? So typically you determine the amount that you want to raise. So whether it's one investor coming in or one note holder coming in with a set amount, or you want to raise a lump sum from various people. Sometimes the convertible note has a goal of raising a certain amount of money, and you float it to different folks out there who would come in with tranches. So say, for example, you come in and you say, I want to raise $1 million. You might go to 5 different investors or 2 different investors to raise that dollar amount. So you have to present the note terms to the investor. One of the items that you would have to go through is you have to make sure that the investor is accredited. It's typically to your benefit that you do that the investor is accredited and understands the terms. So they do that so you don't take advantage of, say, an educated or an investor that is not familiar with what the investment in a convertible notes. You agree on the terms, you know, how long the note will last, how much money you're going to raise. We'll go through some of the term items, things like the discount rate, the interest dollar amount, the conversion targets, and so on. And once you agree on those terms, you actually put those in a document and you execute the note agreement or the purchase agreement. Once you've kind of agreed on to the terms, typically you'll have either an attorney, mostly you'll have an attorney draft that agreement, the purchase agreement, as well as the note, and then you execute it. Both parties sign it, and the note is executed when the money is received, and that's the consideration given, and you're off and running. So the convertible note, as we mentioned before, it's really kind of soft equity. So I've always seen the convertible note, even though it's not it's not equity in itself, and there's no shares tied to it at the time of execution, but you typically see that on a cap table. And the reason is that you know, a prospective investor in a actual equity round would want to know what kind of convertible debt you have in there as part of what's going to be coming in that equity round. So typically you would see the convertible note on the cap table that reflects the amount of money that has come in and the general terms of that convertible notes.
Great, thanks, Alaa. So let's talk a little bit about the actual terms of a convertible note. And as we mentioned before, there really aren't that many, which is one of the benefits and one of the reasons why these are so popular. So we'll talk a little bit about the interest rate. That's relatively simple, as you can imagine, but we'll just mention that. We'll talk some about the term or the maturity date, and there's, you know, probably a couple of like notes and practicalities that we want to discuss there. We'll talk about the discount, and that's one that is a little bit for those who are not familiar with convertible debt. That one requires a little bit further explanation, so we'll go a little bit more into that. We'll talk about the note cap, same thing with the discount. Dive a little bit deeper into what a note cap is, and then we'll talk about qualified financing. And I'll just touch upon that a little bit briefly here because we actually don't have a set slide for that one. And that basically just says that the convertible notes will convert into equity upon a qualified financing, and there's got to be like a minimum amount of an equity financing that will trigger these convertible notes into equity. So, for example, just an extreme case, you know, you're not going to do an agreement where, you know, you take on $300,000 or $500,000 of convertible debt, and then all of a sudden someone comes in and says, "Hey, listen, I'm willing to put in $100,000, and I'm going to give you terms of for an equity round of financing, and that's going to suffice to convert the debt into equity." So it has to be a significant enough amount where it makes sense, and for there to be protection for both the founder and the investor, that it is a qualified amount. Okay, next slide. So the interest rate is obviously, you know, what you're going to be paying, right? So someone someone invests $100,000, and every single month or every single day, we're going to be accruing a certain amount of interest on that, and that amount is ultimately going to be due, both the principal as well as the interest, upon the conversion of this convertible debt into equity, and you know, obviously the method for determining an interest rate is, you know, there's lots of things that go into it. The current interest rate environment, you know, plays a big factor in it. You know, what would be a reasonable amount plays into it. Some negotiation, you know, between the founder and the investors obviously play into it as well. But you know, we're right now in a low interest rate environment, that we're in, for example, right now, we're seeing, interest rates of around 5%. We've seen it much higher in the past when interest rates, when the interest rate environment was a little bit higher. So I've certainly seen interest rates as high as 8%, and I've even seen one at 10%. Right now, round number of 5% seems to be kind of the going rate. The stock interest, again, so I mentioned it before, but this is not interest that is going to be paid out. Rather, it's just going to accrue on top of the principal. And then that amount of the interest that is earned is also going to convert into stock during the equity round of financing. Obviously, the interest will start to accrue on the date that the note is signed. Technically, it's and it should be the same date, but with the date that the note is signed and or when the actual funds are received, should be the same date. And then, as I mentioned before, the interest is paid out when the note converts to stock. So I think that should be pretty straightforward. The term, if we could go to the next slide, Teresa. So the term is basically just, it being debt, there needs to be a maturity date for this note, right? So it's not an everlasting one that can just sit on the balance sheet forever. So there's a date at which by the conversion of the note has to take place into equity, and or per the actual agreement that the funds have to be repaid. But as I mentioned before, that really doesn't happen, right? Practically speaking, if you can imagine kind of the state of the company, you've taken on some debt, you're using it to fund product development, customer acquisitions, whatever stage you may be in, but you're using those funds, right? And 6 months, 12 months down the line, I can almost guarantee that you're probably not in a positive cash flow. You wouldn't even have the cash to repay all of this convertible debt if it were due to be repaid in cash, for example, right? And so even though technically we do have a maturity date, for all intents and purposes, it's a soft date, right? So, you put in a date in the agreement, say it's 18 months, say it's 24 months, in practicality speaking, if we get to that point and we still haven't converted that debt into equity at this stage, usually what happens is you just kind of lengthen or prolong that maturity date, and you put in a one-page addendum to the convertible note that's approved by the investors that says that, hey, listen, originally this note was due on December 31st. We're going to actually increase that maturity date to March 31st or June 30th or whatever it may be. And the reason you do that, and the reason that it makes sense for both you as the founder as well as the investor, is because again, you probably don't have the cash to repay it. It was never meant to be repaid. Investors who are investing in this is really looking at it as an equity investment. And so it's just giving you time to actually turn this into equity. Okay.
So Sirk, there was a question that said, okay, if the notes are never meant to be repaid, or then why even call it debt in the first place, and why all this? It is a debt instrument, and a lot of the times that if the company was hypothetically not to raise another round of financing, there are provisions for then the company to either repay it or have the option to repay it. And in some cases, I've seen some kind of security agreement tied to it. For example, a company might relinquish their IP rights if they never repay it, or there could be some other kind of security attached to it. So it is technically a note instrument. So in the event that there is no conversion, or no equity conversion, there are provisions for repayment one way or the other, or typically security. Is that what you find, Sirk?
Yeah, and thanks for that, Alaa. And I do see the question from Balaji. Thank you so much, Balaji, for that question. So technically speaking, it is a debt instrument, and therefore there are some protections that that typically come with debt, because they're first in line, or they're ahead of the equity shareholders in terms of any kind of liquidation or any kind of return of funds to investors. And so there is a little bit of that protection, and as Alaa mentioned, there might be other things in there like security on IP and things of that nature. So during the time when it is convertible debt before it turns to equity, there is some protection. My comments about for all intents and purposes it should be treated as equity is that I've never come across a situation where convertible debt is actually paid out in cash, right, or repaid. It's always a precursor to equity. That's what the founders intend. That's what the investors intend. And so it would be a pretty corner case for it to turn into a much of value, other than for example, if the company goes bankrupt, for example, then the debt holders might be able to say that they have claims on some assets, including IP of the company. So during that interim before it turns into equity, convertible debt does have some of the protections of debt versus equity. Okay, so thank you, Teresa. So the conversion discount. So the conversion discount and the note cap, which we'll talk about on the next slide, are kind of the two main ones, the two main terms that are going to have a big impact in terms of how this convertible debt turns into equity. The conversion discount basically says that for people who are investing in this convertible note, that upon the conversion of this convertible debt into equity at that qualified equity financing, that the note holder will actually be able to purchase shares or be able to convert into shares of equity at a discount from the actual equity shareholders who are coming in at that stage. And this basically is as an incentive for people to invest earlier on. Someone who invests, today, right, when there's more risk, should get a little bit of a bump in terms of equity as someone who's going to invest 12 months from now, right? To the extent that we're going to do an equity round of financing 12 months from now, the idea is that we will have made more progress, we'll have hit more milestones, the company should be further along, and therefore a little bit of risk has been taken out. And so to compensate you, the note holder, for the risk that they're taking today, that the convertible note term sheet will basically say that you'll be able to purchase shares, or this will convert into shares at a discount. And so you can see that that a 20% discount has kind of been standard in the past. I've seen it as high as 25%, really never more than that. And that depending on how compelling the your company is, how compelling of an investment it is to potential note holders, that you might be able to get even less, right? 15%, 10% discounts. I don't really see 0% discounts. We don't see that. That's just put in here, like for example, if it really is a corner case that we don't see very often. But if you have a very compelling argument and you have lots of people who are interested, you might be able to float terms that says that a note holder will get at a discount of less than 20%. So just as an example, let's say in this next round of financing that equity shareholders are going to be purchasing equity at $1 a share. Right, so your convertible note or the convertible note holder will actually be able to purchase shares at 80 cents a share, and obviously get 25% more stock for that. And I'll let talk about the note cap.
Okay. Before we move to the note cap, I see that there is a question related to biotech. While I am not a biotech expert, I think the gist of the question is that the biotech cycles are typically a lot longer. You know, for example, if you're working on, you know, some kind of drug or some kind of instrument that is going to have either a long development cycle or a long regulatory approval cycle, then you know, these notes are typically not for 1 year. Certain industries, you're absolutely right. The convertible note may not be a short-term note, but what I've seen in my limited exposure in biotech, and maybe Sirk, you could add if you have more experience, is that convertible notes are usually used very early on. And then financing rounds, equity rounds are then come into play at certain early stage that will help fund these long cycles in biotech. So, for example, if you're going through some kind of regulatory approval process, I very rarely see a convertible note fund that. It's usually a financing round or an equity round, and typically biotech investors are savvy enough to understand what that takes. And once you get to those phases, then usually equity is raised to get to the longer term. But that's not to say that convertible notes have to be short term, meaning a year or less. I've seen convertible notes last as long as 3 years in some cases. The majority of the cases that has happened because the company has not been able to secure a funding round, and the investor kind of keeps holding on to the note and either extending a 1 year note, or they've kind of baked that into the initial agreement by making the convertible note a 3 year term because they understood that that things will be taking a little bit longer. So so I think you know, to address your question directly, that the you know, longer terms, whether in biotech or other industries, they're it's the note is flexible enough to take that into consideration. Sirk, do you have anything to add to that?
No, no, I don't. Yeah, that's great, Alaa.
Okay. So convertible note cap. So typically when you get into the agreement, there are conversions provisions. So the conversion provision will either will set a max for the valuation of the stock that this note can be converted into equity. So the reason why we do that is that it aligns the incentive from the investor and the company, that essentially what we want to do is we want to bridge the company or finance the company till we go out there and find like savvy investors that we could negotiate valuation terms on, with. So by setting that note cap, it kind of aligns both the goals of the company and the investor who executed the convertible note. So the notes will typically convert under two scenarios. One, either the lower of whatever the pre-money valuation. So when you go out and raise a round, the first thing that you do is you negotiate with your prospective investors a pre-money valuation or a valuation prior to you raising the money. So, for example, if you go out there and you negotiate that your valuation of the company or before you raise the money is $20 million, that means your pre-money valuation is $20 million, and if you raise another $20 million, your post valuation will be 40. So typically when you see these equity, these convertible notes, they convert at that pre-money valuation rate, the rate that you've negotiated with your prospective investor. So it's either that or it will be the cap that has been set in the negotiation. So the conversion will be one or the other. It's not going to be both. So typically it's the lower of the two that the conversion happens. So you either can convert the note either using the pre-money valuation in the next round or the note cap. So what should you watch out for when you're negotiating a convertible note? I think you want short maturity dates because you want to keep in the focus that this note or this instrument is going to get you to your next equity round. Do not put in an excessive discount. That's going to scare off any potential investor. So, you know, things like, you know, 75% discount rates or greater, that's something that you shouldn't go into. Remember, it's not just to your benefit, but it's also the benefit of the note holder that that note converts, because typically they're investing in a company that is not liquid and will not be liquid until that equity is raised. So it behooves both parties that the discount rate is not excessive. Make the other thing to kind of watch out for is that make the note and the covenants flexible. Do not make them burdensome, restrictive, and the covenants on the notes so restrictive that, again, it scares off future investors in your company and restricts your ability to raise money in the equity market. And then finally, make sure that you're, you know, talking to somebody who's an accredited investor. Now, I say that kind of tongue in cheek because, quite honestly, I've seen so many companies execute convertible notes with Uncle Bill or Aunt Maggie, you know, friends and family that may not be accredited investors. So that notion, I think, is a sound notion, just because an accredited investor understands the risks, the up and down profile of various companies. They understand that they may lose the money that they invest, and also it takes away a big liability and the legal hassle from you down the line in case things turn south. So working with accredited investors is always preferable, although in practice, that may not be always the case.
Yeah, keep in mind, you know, at the time of the convertible note, there is absolutely nothing that's that keeps you from taking money from uncle or aunt. I forget the names that Alaa used, but there's nothing keeping you from doing that. However, the thing to keep in mind is that, you know, when this convertible note turns into equity, that to the extent that you have investors who are purchasing equity in your company, who are not accredited investors, you need to jump through a lot more hoops in terms of filings, you know, with regulatory groups to basically, you know, notify, you know, them as well as the investors. And so it really, it's going to end up being a lot of more work for you. It's gonna, it's gonna make it a little bit more difficult, time's taking, a little bit more expensive. And quite frankly, you know, you may throw off some investors who potentially might want to invest in your company, but then they see that, hey, you've got some unaccredited, non-accredited investors on your convertible note that's going to turn into equity. And so, you know, while it can be done, we highly encourage you to think about that in advance before you take money from a non-accredited investor.
Alaa and Sirk, I have a question from Andre. He says, thank you for the presentation. Convertible notes really seem to benefit the investor more than anyone, i.e. offers the protection of debt, including interest, with the benefits of equity plus a discount. Am I missing something here? What's the benefit for a company? Why not just raise debt or equity?
That's a good question. I mean, obviously, if you are comfortable raising equity at this early stage, then nothing that's keeping you from doing so. We find that a lot of companies just aren't in a position to do that, right? It may be too early. You really don't know, you know, how big the market is. We haven't made much progress in terms of product development, and it's too early for an equity investor to get involved. And even if you find someone who might be interested in equity investment, it's so early that it's really hard to put a valuation on the company. company, and you have to put a valuation on the company to actually price out equity. And it's for those reasons that you would do convertible debt. Absolutely, there is protection for the investor. However, there is, the benefit for the founder is that you get in funds into your company. It's quicker, it's easier. It'll close faster. There's no negotiation or very little negotiation that needs to be done. And so it just streamlines the founder's ability to get cash into the door, financing into the door to help the company continue to grow at an early stage when it might not be practical to raise equity. Debt, if you're talking about taking out bank loans or venture debt or things of that nature, yeah, absolutely. But the problem with that, of course, is that you have to pay it back. Right. And that's kind of the big thing. And also, again, at a really early stage, it's probably, it may be very, very difficult to take on a significant amount of traditional debt at this stage of the company.
Yeah, I mean, I think you have to kind of look at it from a company in a fledgling state where the company doesn't have a lot of history. Typically, they are not making money, so bank financing is off the table, and typically they're not at a run rate or a runway or a developed state that they could go out to the equity world and say, okay, a company similar to mine was valued at X, and I need to be valued at that company, and have a credible valuation discussion with with either a VC or some kind of equity investor. So in those early stages, a company is at a real disadvantage, and attracting money and having those valuation discussions are probably not very fruitful. You're either going to overvalue your company and scare off a lot of investors, or you're going to undervalue your company and dilute yourself. So if you're fortunate enough to be in a position before getting any convertible notes to go out to the investor world and negotiate a fair valuation, and that the investors come in and are agreeable to that, then fine, go ahead and do that. Or if your company is making money and are bankable, you may want to avoid the equity market in total and just go directly to bank debt. But in most cases, convertible notes are not really meant for those types of companies. Convertible notes are meant to bridge the company in an uncertain state before they go in and are able to have credible equity discussions with equity investors.
Great, and we'll just, and we really apologize for this eye chart here. It's really not meant for you to dive in. We just have, two conversion examples. The first conversion, they actually use the same exact numbers for everything, for all the shares outstanding, the note size, the note cap, the discount. The only difference between this conversion example and the next one is that the Series A valuation is different, right? So the Series A valuation here is $4.5 million, and the next one is much higher. And really the point of both of these slides is that what you do is you do the calculation of the conversion, right? Depending on the numbers here, and depending on the valuation of the Series A at that time, you will convert either using the discount or the cap. In the first example, the note holder was better off by using the discount conversion, because at the Series A valuation of $4.5 million, that the 20% discount that they were getting would give them a better piece of the equity upon conversion. And in the second example, when the Series A valuation is much higher, 13.5, however, the note cap is still at 4.5. Now what you're doing is the investor is actually able to invest in the company as if the company is valued at $4.5 million instead of at $13.5 million. And the reason, and we highlight this here, and the reason why this cap is in place is because, a lot of times the investor for a note at this stage is going to say, look, you know, a 10, 15, 20% discount, that's okay. However, boy, that's still a lot of risk that I'm putting into my money right now when a big round of financing is going to come down the line, and who knows how much I'm going to be diluted, right? Let's say current note holders put in, $1 million, and they're thinking at this point, they don't know how much equity that is, right? They won't know how much equity that is until it converts. And let's say they're kind of doing their numbers and they're saying, oh, well, I think this is going to be, 10% of the company. I think it's going to be about a $10 million company, and we're putting in $1 million, and I think it's going to be about a 10% of the company. And then in the next 12 or 18 months, between the time that you close this round of convertible debt and the time you go out to go get equity, let's say you really blow it out of the park, right? Let's say you really, hit upon a huge market potential. You've done great work on the product development. You're getting some great traction. And now equity investors are really, really interested, right? And now they're coming in and they want to put in, instead of having the company be worth $10 million after the next round of financing, all of a sudden now the company's worth $50 million, right? Well, now that early $1 million investment is only worth 2% of the company, right? And so, a lot of convertible debt investors are obviously sensitive to that. And so to provide them some upward protection in terms of valuation, we use this cap that says that, you put in money now, we're hoping to use this money to improve our company's valuation. And, we're not going to use your money to increase the valuation so much that you get diluted out completely. Right. And so that's really the goal here. And so you put in a cap in terms of the valuation so that it provides some upward protection to the investor, to the convertible note investor, that they're going to have at least a minimum amount of equity in the company. And the benefit to you, obviously, is that, you negotiate a cap that makes sense to you, that if the company is worth more than this cap amount, yes, the note holder gets a little bit more than they would have if the cap wasn't there, but you are going to be thrilled because that means that you've really, really made, a lot of progress with the company, and you're getting a much higher valuation than you probably were anticipating at the time of the note. And I think this is our last slide, and this actually kind of touches upon, I think, a couple of questions that came in regarding safes. So there's the downsides of a convertible note. Let's talk about that first. So obviously it's still debt, and early stage investors really want equity, right? And so how do you bridge that gap? And that's kind of what this is really meant to do, is to kind of bridge that gap between this early round of financing where you can't come up with a valuation and it's too expensive, towards turning it into equity. Debt incurs interest. Do investors really care? Probably not. It's not going to be that significant. If you can imagine, 5%, right? So if we're talking about $100,000 investment that a note holder is making, that's basically, $5,000, right, in a year. And so it's not that significant. And so, why does it matter? And then, technically debt has to be repaid. But what if you can't, right? And typically that's what's going to happen, right? If 6 months, 9 months down the line, the debt holder all of a sudden says, hey, listen, I'm getting a little bit antsy and I want my money back. Well, typically we're not in a position, in terms of having cash available, because we've been using the money that we raised to fund our company. So we're really not in a position to be able to pay it back. And so, for all those reasons, the question of, wait, so why are we doing convertible debt as opposed to like a simple equity agreement? And that's, basically, to answer several listeners' questions about safes. That is something that is now available. So SAFE is an acronym for a simple agreement for future equity. And it was originally created by Y Combinator, which is one of the most successful accelerators in the country. And they basically asked the same question of, well, why can't we do something that's simple, that makes it very, very easy? The terms are, not, they're pretty standardized. And yet, instead of having this sit on the books as debt, it'll actually turn into equity. And I guess this probably isn't the best venue to have a long discussion about that. We spent the bulk of the hour talking mostly about convertible debt. What I would encourage you guys to do, to the extent that this is of interest to you, is we meaning Early Growth Financial Services, we have done a bunch of past webinars on safes, as well as other financing instruments. And we encourage you to look on our YouTube page or check on our website, and you'll probably be able to find past presentations, past webinars where we've done the deep dives into safe agreements and other early stage funding vehicles as well. But suffices to say that this is it's not a hey, this is great for everyone. It takes care of all of the downsides of convertible notes and still retains all the benefits of convertible notes. There are absolutely some gotchas that come with safes, and so we encourage you to kind of do a little bit of research on your own, do a little bit of research on the web, as well as check out our past presentations. And I'm sure we'll be doing more in the future as well. So we encourage you to sign up.
Awesome. Well, thank you, Alaa and Sirk, for this amazing presentation. If there's any more questions in the queue, unfortunately I'm unable to pull it up, but if there's any more questions, we can do those now. If not,
I see one. I see one from Estelle. She is asking if you have access to your own money as a founder. Is there any advantage to setting yourself up as an investor with convertible note or money you put into your own company? Typically not, right? So if you're a founder, you obviously have a significant equity stake in your company. You're going to be a common shareholder in your company, and you're going to retain the bulk of the equity. So really, convertible notes are meant for outside investors.
Yeah, and just one final thing, that money the founder's money that you're going to be putting in, I think if you were to talk to anybody an attorney that is helping you with, or if you were to talk to one of our CFOs, you'll find that you'll get a lot more bang for your buck for that seed money that you're putting into your company to be part of your founder share pool. There's so many companies that are very, very advanced up to their C round and so on, that the founders still retain a significant amount of the equity in the company just simply by their initial funding, and that you might actually be doing yourself a disfavor of putting that money in through a convertible note. Because yeah, if you have that money available to you, that's very, very valuable early on. You didn't have to go out, and that gets valued into your first or your next round of financing, that you've put in not only your sweat equity, but you've also put in this chunk of money, and that gets valued into the founding share calculation.
Yeah, that's exactly right. Excellent points, Alaa. And one final thing. I know we just got a minute here. I hope one message that you've got out of this is that if you're a first-time founder, and you're either going through the stage or you expect to go through the stage, you can see there's a lot to it, right? And you'll quickly, once you go through it once or twice, you'll quickly become a relative expert. But if you haven't gone through it before, or even if you have gone through it before, and you're thinking about, you're thinking about the process of doing this, we really, really encourage you to work with counsel that knows what they're doing, and knows their way around early stage financing. So, while you may be using, a family friend as an attorney for contracts, or you may be using a small local firm to save money, on your legal work. When you get to the stage where you're really, going out and thinking about raising external money, you're going to want to work with a firm that is experienced and knowledgeable about not only convertible debt, but also about safes, and so just make sure that you're working with the right attorney and right firm that has the resources that are going to be able to provide you good counsel as you go through this process.
Awesome. Well, thank you again, and thank you to everyone who participated, attended this webinar today. If you were not here right at the beginning, this will be available to you, a recording of this webinar within 48 hours, and you'll see that via email. You can also find this webinar on our YouTube page for Early Growth Financial Services. Thank you so much for joining us, and we will see you for our next webinar.
Thank you, everybody.
Hello.